Well, guys, today on this podcast, we're going to be talking about finance solutions in a high interest rate market. We're going to introduce our preferred lender, Don Owens, and we're going to talk about inflation and what does that actually mean for you.
Hey guys, welcome to The Buzz, Coffee and Real Estate. Today we've got Don Owens from the Hamilton Group on with us, and we're going to let him tell you a little bit about himself and his team.
Sure. I'm Don Owens with Hamilton Home Mortgage. That is our new name as we recently merged with Lower.com. I have oversee 2 branches in the Triad area of North Carolina. We are a very much purchase-driven mortgage company or mortgage team, and a fantastic team I do have.
So you got, how many people do you have on your team right now?
Well, I do oversee 2 branches, and each branch has a number of different loan officers in there. And then we also have a production team of have a bilingual processor that lives in Miami,
Cool.
So we can handle folks who prefer to speak Spanish and that type of thing.
Yeah.
Cool. Awesome.
And I've been in the business since 2003, so this is my 19th year.
Well, almost hitting 20.
Awesome. Well, I met you, Don, back, years ago when I very first started in general brokerage. And it was through another agent who was a lot more experienced. And she said, hey, you got to meet this guy. And what I was really impressed was your ability to teach. So it's easy to spout complicated lending terms, but to actually be able to take one of my first-time homebuyer clients who doesn't know what in the world to do next and bring all of that complicated knowledge down into simple-to-understand terms. And so that was what first impressed me. And then I've gotten to, of course, interact with many other lenders over the last 5 or 6 years. And I keep going back to, wow, that was complicated and confusing. Or they were just totally inept, and so that's continued to bring me back to, hey, we need to connect with this guy in a more formal way and really introduce him to the folks that we're walking with so that you could bring your level of expertise to our clients.
Yeah, no, I think that's a pivotal point. When one of the things when Cam brought you kind of up, it's like, hey, let's talk with him about being a preferred lender. I said, well, the first thing I need is somebody who's smarter than I am. And Don has definitely been that.
Well, because you worked in lending for 8 years.
Yes.
Yeah. So, I mean, you've spoken with people in the lending industry, and you're having to teach them their own job.
Exactly.
Yeah.
Yeah.
Well, one of the big challenges in mortgage lending is a lot of loan officers and lenders take it kind of like an order-taking mentality. Okay,
right.
You want a 30-year fixed conventional loan, you're going to put 20% down. Okay, great. Would you like fries with that? How about a drink? Can I supersize it for you?
Right.
All right,
Right.
have a nice day.
Right.
And I like to take a much more in-depth approach of looking at the customer's total financial picture, what their goals are for the future, and then tailor the transaction to meet their needs the best. And right now, in this environment, strategy and how you structure a transaction makes all the difference in the world. The order taker mentality is completely out the window right now. It's not about a 0.25% better interest rate. It's about what is the strategy to give the customer the lowest payment possible.
Yeah.
Not just today, but throughout their entire, not necessarily the course of the loan, but their entire goal, their entire strategy for this home. How long you're going to be in it, what are your goals for the home, all that sort of thing.
Sure.
Yeah, so you were telling us something about some sort of 2-1 buy down something or another. Go into a little more in depth on that.
Sure. So, right now, this is a time where we have the highest interest rates basically since 2006 and maybe even earlier in some cases. So we're in a higher interest rate environment than people are used to. And there are opportunities now where you can take a customer who is terrified of what their payment might be and structure the loan in a way that they can get a payment based on a rate that's a lot lower. So you can't get a 30-year fixed mortgage rate in the 4s right now, but you can, with the right structure, get a mortgage payment that's based on an interest rate in the 4s.
Oh, wow, cool.
And you do that through a 2-1 buydown, where the seller funds a portion of the buyer's payment for 2 full years. So, for example, let's say the rate is 6.5%. Well, the customer pays the interest and principal on 4.5% for the first year, and the seller pays the other 2 to bring it up to the full 6.5%. The next year, the seller pays the 1%, the buyer pays the 5.5%, again to bring it up to the full 6.5%.
Gotcha.
And then the third year, the customer pays the full 6.5%. of principal and interest. However, the idea is to position so that when the market does shift, and hopefully it will improve dramatically over the next year or so or two, the customer can go in and refinance and restructure the loan to their permanent financing.
Gotcha. So it's a short-term solution for what you're saying is a short-term problem, which we'll jump into in a few minutes as far as inflation and what's happening even right now today as we're recording this podcast. But so this 2-1 buy down, so you said, okay, the seller is paying basically the 2 points interest rate. So we're just starting to see, we haven't seen this in 2 years, where you can present an offer on a home and actually ask for seller-paid closing costs. And because every home has had 15 offers on it for the last 2 years, that wasn't even an option. That was a guaranteed way to lose a bidding war.
Totally.
Sure.
But we're starting to see that now. And I've actually had my first client. I mean, I didn't even know whether I could ask for it. I talked with a listing agent. Wow, can we even do this? But the market has shifted in such a way now where that's become a viable option for offers. And so what kind of seller paid closing costs? I know it depends a little bit on the purchase price, but you know, like, hey, are we talking a few $1,000s could help that 2-1 buy down, or what are you talking about there?
Oh, certainly. So it depends on the loan program. Okay. A conventional loan, you're going to be capped at 3% for a primary residence. So 3% of the purchase price.
So that's 3%, like, so a $200,000 house, $6,000 would be the absolute most that the seller could contribute towards
The
it.
seller could contribute the $6,000.
Gotcha.
And actually, it could even be a combination of the real estate agent, the seller, and the lender all coming together to give the buyer the best possible solution.
Oh, cool.
Gotcha.
But each program does have a cap of how much can be contributed.
Yeah.
And what are called third-party concessions.
Okay.
So when you're talking about that, you're talking, so just going back, you said seller can give some, agent can give some, which we haven't heard that one in a long time, which is basically where they're saying, hey, I'll give you a little bit of my commission to be able to compensate and maybe help this deal out.
Sure.
And then we're also talking about a lender credit potentially.
But all of it added together cannot exceed
That's $6,000 in that
right.
scenario.
And so
Gotcha.
conventional loans will have the 3%. A VA loan will be at 4%.
Okay.
And then you have FHA, which will go up to 6%.
Oh, wow. Okay.
Okay.
If the seller will actually agree to that.
Do that.
Yes, but you're saying as part of the negotiations from a lending perspective, you have up to that amount that you could use.
Up to.
Cool. Okay.
And so, the idea here is instead of dropping the purchase, if the property's been on the market for a little too long and the seller is going, well, let's just drop the price, and they're
Right.
going to drop it $10,000. No,
Right.
let's take that $10,000 and let's make it a seller credit to help the customer, the buyer, get a lower interest rate.
Yeah, which we actually seen this. One agent had posted this, and I think it was like new construction kind of feel. Might have been with Windsor. I think you had mentioned that too. And they were saying, hey, this is what we're willing to do. We're going to give you X amount of dollars towards this, or we're going to pay up to this amount.
Yeah.
Because I think when we talked, you said FHA, you could go a little bit higher, and some of the other like government loans.
6% for FHA.
Yeah. Very cool. So maybe more effective than a price reduction is a seller credit. We're keeping that home at 3.25, but we're going to offer a seller credit towards a potential, buy down program or something.
And there's
like
a lot of reasons why that's a better thing for the buyer too. Because if you start cutting prices in a neighborhood, then all of a sudden the prices start going down in the neighborhood.
True.
So that's a kind of very self-defeating.
Yeah.
We don't
Yeah,
want
makes a
the
lot of
market
sense.
to slip into a period of time where home prices plummet because everybody's dropping the prices
Right.
of their homes.
Right.
But helping some buyers buy
Yeah.
in a high interest rate environment is a much better solution because it keeps intact the value of the neighborhood.
Right.
That's right.
That makes a lot of sense.
So we're not going to see this dramatic drop, and then all of a sudden everybody's freaking out because they've lost equity in their homes.
Right.
Yeah, there's no need to panic. There's no need for the market to adjust in a way that is in any way, shape, or form panic in nature.
Yeah. No, that's
Very cool.
That's a wise. I mean, we just talked about this. We had a seller.
Yep.
And the seller came in and they're like, we had kind of talked. I think you had said, hey, well, maybe we should do a price drop. And I said, why don't we do closing costs instead?
Yeah.
And that was kind of the initial conversation. We're like, oh, that would actually do better because now
Sure.
we keep the market strong.
Well, and if you drop the purchase price $10,000, it barely makes any impact on the buyer's
Their payment. Yeah.
But if you take that $10,000 and you buy the rate down and do a 2-1 buy down, it makes a dramatic difference in the payment.
Wow. That's really cool.
I mean, you think about it. We've been, in a lot of cases, maybe not just us, but in agents in general, they've kind of steered away from an FHA or a VA or even USDA for
Yeah.
that matter for the last 3 years.
Yeah.
And so now those things are kind of coming back up, and they've got a lot of those benefits, like you said, 6%. I mean, that's a $200,000 house. That's what you're talking.
That's $12,000.
Yeah. So that's a significant amount of money that can help that buyer get that payment, which is what they're concerned about in the first place, to the place they need to be. And then you had mentioned something about a refinance kind of program that you guys have that kind of taps onto the back end of this.
Sure. So, the idea, again, is to get the payment as low as possible for enough time so that the customer can adjust, but also, strategically refinance when the market's right. Okay. Yeah. So, I should talk a little bit about stacking benefits. Yeah. And one of those benefits being a refinance program. But, so for example, instead of just doing a 30-year fixed, the 30-year fixed is always going to be the highest price mortgage on the market.
Because it's the highest risk
it is.
For the lender. They have to promise to keep the rate the same spot for 30 years, and that's a long time. A lot could happen in 30 years.
Right.
Yes.
So you can get a lower payment with a 30-year amortization on a 7-year arm. That's then the loan is the rate
Paul's
is
ARM
fixed.
is adjustable rate mortgage.
So
okay.
the rate is fixed for 7 years, but it's going to be anywhere from 0.5% to 0.75% lower than the 30-year fixed. Yeah. So now you've got a lower payment, a lower start rate for 7 years, and then you stack a 2-1 buy down on it.
That's right.
So now you've taken that rate down for the first year another 2 points.
So you can take a 2-1 buy down and stack it on top of any of the different loan programs.
Right.
On a fixed or adjustable, FHA, VA, USDA, or conventional.
Yes.
Well, the beauty of it, too, is you're talking a 7-year fixed rate.
Yeah.
So we know, just looking at history, that in 7 years, it's going to be a lot lower than it is now.
Yeah. What did you say? The interest rates have never gone up for more than how many years in a row?
3.
More than 3 years in a row.
From 1977 to 1981, rates went up.
Okay.
Constantly.
Okay.
Then in 1982, and about the middle of 1982, they started to gradually go down because mortgage rates usually go like this, either go gradually down or gradually up, or just kind of stagnant.
Right.
They don't go in a straight line like they have the last 6 or 8 months.
Yeah.
So from 1977 to 1981, they pretty much went straight up. Then,
we were at 18, 19% interest rates.
Yep.
Nuts. Yeah, back in my parents' era.
I was going to say,
I remember them.
Here.
Yeah, their first little house was like 18% interest rate.
Yeah. But their house was also $40,000.
Well, true. Yeah.
And then Paul Volcker, who was the Fed chairman at the time, he stepped in and, of course, rapidly rising interest rates to crack inflation.
Okay.
The same situation. That was due to inflation. Yeah. Cracked inflation with high interest rates, and then once inflation started to get under control, rates started going down, and they continued to go down into the mid-90s.
Yeah.
Gotcha. So it's this slow, gradual decline. It was a shoot up, kind of like what we're seeing now.
Yep.
Yep.
Super fast, and then gradually going back down the hill.
Stair steps.
Okay.
And it's very likely that we've seen or we're close. We have either seen the peak of rates on October the 20th, or we are approaching the peak.
Yeah.
We have a little reversal today, but before I get on that, talking about stacking the benefits, one thing we're doing for our customers is once they close on their purchase, we're going to help those customers refinance when rates improve by waiving our lender fees and also helping the customer pay their closing costs, with the exception of taxes and insurance, because that's not a closing cost, it's taxes and insurance.
That's right.
Or if the customer chooses to buy the rate down below what's available, then that's a choice. That's not a
But basically you're saying, hey,
we would pay for.
We understand you're buying a high interest rate right now, so we're going to give you a free refinance, minus they got to pay their taxes and insurance, later on down the road when rates have shifted, and we can shift you into something that's in a lower interest rate.
We will help the customer improve their financial situation for certain at minimal cost. I can't say that we are doing it for free.
Yeah.
I have seen lenders out there marketing for free, and they're waiting for a call from the CFPB.
Okay, all right. But what you're saying is we can waive certain fees.
We will zero out our fees and
Gotcha.
help with the third-party fees.
Okay.
for
And
our
let's
refinance.
touch on that. So you said taxes and insurance. First off, if they're already in a mortgage, they're most likely they've got an escrow account.
Right.
Yep.
So that escrow account is going to either have already paid the taxes for the year if you're around the September marker, or you've had a lapse. So you may have to pay whatever the difference is for the year,
Right.
or you're going to get credited back.
And
Either way,
let's
they're probably
back
going
that
to get a
even
refund.
one more step down. An escrow account is just a savings account.
Yep.
So your payment, and then and you're going to see it as just one number on your payment.
Yep.
But actually, a little bit of that payment each month goes into a savings account, so that at the end of the year, your lender, ABC Bank, whatever it is, automatically pays the taxes and insurance for you.
Yeah, or PMI if that's the case too.
Or you could be like me, and I get the bill in the mail the first year that I owned a home. I'm like, oh snap, I got to pay this bill, even though it was escrowed. So I paid the bill,
Yep.
and then they paid the bill, and then months and months later, they told me, oh, you double paid, so we'll give you back
That's
a chunk of
exactly
it.
right.
But typically, it's been escrowed, so it automatically gets paid every year.
That's right.
Okay.
So you'll see that where you're going to see some of that refund come in.
Gotcha.
So like I did this myself when we refinanced our house. It was like this. Like nobody told me about it until it happened, and I was like, "Oh, I got this check for like $1,000. Well, I have this check for $1,000." My wife's like, "Well, that's nice." I'm like, "Yeah, but I want to make sure why we got it."
Yeah.
And then of course I called the lender, and that's what they told me. "Hey, you're getting a refund because you refied. This is the remaining balances in your escrow, so forth."
Gotcha.
So you may have to put out that taxes and insurance amount,
Yeah.
but you're probably going to get some of it back.
Well,
in
and
some cases.
it doesn't necessarily have to come out of pocket because home values are still very
true.
very high, and home prices are going to continue to appreciate. So you buy a house now, it's likely going to be worth a little bit more next year, a little bit more the year after that.
that's right.
Because that's just the trend.
Yeah.
And it always has been. There have been dips in the market, but it's very rare. Most of the time, values continue to gradually go up. But when you refinance, you don't have to come out of pocket and pay the taxes and insurance. You can just roll it into the cost of the loan.
Okay,
But
gotcha.
then when you get your escrow refund from your previous loan,
Put it
it's
back.
either put onto your payoff, which
Yep.
reduces your payoff, or you get a check back after closing, like you mentioned.
That's right.
Okay. So circling back then, not only do we have these loan stacking programs
Yes.
using adjustable rate mortgages, and we can dive deeper into another episode of because a lot of people are just terrified of adjustable rate mortgages.
Oh, totally.
And for good reason. It burned a lot of people before. So it all depends on the terms of that. We'll set that aside for a second. But what you're saying is we're stacking loan programs on top of loan programs. This 2-1 buy down on top of a fixed rate or an adjustable rate. And the added benefit of being able to, on the back end of that, refinance at a lower cost into an interest rate once we see them stabilize in a better market.
And then, of course, tying into all of that this is a market right now, today, where a seller will gladly help a buyer
That's right.
pay for those
Right,
costs
right.
for the 2-1 buy down
Right.
or the paying the closing costs or
Okay.
just even doing a permanent buy down.
Gotcha.
Although right now I don't recommend a permanent buy down on interest rates because most people who get a loan right now will be refinancing when rates improve.
Oh, totally.
Okay. So no need to buy it down for the whole 15 or 20
Just
or
do
30 years.
Do the 2-1 buy down.
Buy it down for a couple of years.
Well, it's like you said. I mean, I think historically we've kind of seen that where that 1 to 2 year marker, we start seeing that decline on rate or whatever's going to change. And we've said this before is that, typically if you're 8%, you might be in the 6% range within 2 years or so. And that, not exact math,
Yeah,
but,
well,
it
probably
could
not
be
back
about
to the
right.
3%.
That's right. We're not going to see it
Probably
dropping.
not.
in
That
those.
was an anomaly.
Yes.
That was caused by some certain factors. So
Oh, definitely.
Well, one thing that's a sure driver of lower interest rates are, economic disaster like
Yeah.
we saw in 2020. We had basically the highest unemployment rate, the highest 2 years ago since the Great Depression.
That's right.
I mean, it was unbelievable. Right now, we may have a week where 200,000 people or 220,000 people file for unemployment for the first time. But just 2 years ago, we were seeing weeks where 2 million people were applying for unemployment for the first time. We had months where 10 million people applied for unemployment for the first time. You see, everybody wants a strong economy until you have a strong economy.
That's right.
Right now, we have a strong economy, and that's what's driving inflation up because everybody has a job. Some people have 3 jobs.
That's right.
And they're being paid well, and they're buying everything they want.
Yeah. Yeah.
Yeah, and you're seeing that they can get as many jobs as they want until we start seeing that change like we're seeing now.
We're starting to slowly see unemployment rates go up, but nothing like we saw 2 years ago, 2 years ago.
Yeah. Well, and certainly back in 2008, 2009, when you had all these major financial institutions fall apart.
Same thing.
And so that unemployment was super high back there too. So this whole concept of like this temporary, because you've been talking to me when you and I talked when interest rates back in April and May when things first started taking off. Was it April, May, March? Okay. So and you said, hey, just because the news says that the Fed has gotten together and raised interest rates doesn't necessarily correlate with mortgage rates going up, and that just blew my brain. So can you explain just a little bit about mortgage rates are chasing something, and the Fed is raising rates to control something?
Sure.
Bring a little clarity there.
So the Fed raises the short-term interest rates.
Okay.
Keeping in mind that mortgages are long-term interest rates.
Okay. That's right.
They're not tied together. So the Fed increases short-term interest rates specifically to slow inflation or slow the job market.
Okay.
And that's what they're doing now because the job market is too hot and
Gotcha.
inflation is too hot.
Gotcha.
Now, what you're saying with short term, we're talking like auto loans, we're talking home equity loans, maybe some of those. Is that what we're talking about?
Overnight lending rates, where banks lend each other money, or even money that's borrowed by banks directly from the Fed.
Gotcha.
Those rates are what the Fed has been increasing. Now it does affect your home equity lines. It does affect your credit cards. That's why every citizen in the United States who has a credit card has seen their interest rates go up because it's tied to
The prime rate.
exactly.
Yeah.
So, but we have seen mortgage rates go up at the same time that we've seen the Fed raising rates.
That's because of
Investors
inflation.
Okay.
But very specifically here, back in March and even April, you heard the Fed saying that that inflation was transitory. So what the Fed was saying is the reason why we have inflation is because we're going from the pandemic lockdowns to full employment.
Yep.
So everybody's spending money, so that's driving up inflation. And so, mortgage rates weren't going up quickly. They were going up a little bit, but that all changed a few months ago when the Fed changed transitory to entrenched. When they said inflation
That's
is
more long-term.
entrenched,
Yeah.
it totally freaked out the mortgage rate market. Mortgage-backed securities sold off like we haven't seen in years.
All the investors.
And mortgage rates basically went up a full percentage point overnight.
Ooh.
Yeah. Well, I mean, it makes sense, though. I mean, you think about it. If I'm an investor coming in to buy a loan, I'm looking at it going, hey, this is a long-term investment. I'm going to make X amount of dollars.
Right.
But if I see the rates jump like they are and the anticipation, which we've seen through history, that they're going to come down,
Yeah.
the investor's going, this isn't worth my time. I'm going to lose money.
Right.
So it's a short-term gain for them, which is also going to be the reason why you see the rate jump as high as it does.
Yeah.
Yeah. So interest rates for
Red light's
mortgages.
It's good.
Okay.
Good to go.
Yeah. Pause. Go ahead.
So interest rates for mortgages were going up because inflation was going up, is what you're saying.
Precisely.
And so, explain a little bit what's happening right now as we speak that is starting to give you indicators that something is shifting.
So today is November the 10th, 2022, okay? And it just happens to be a day where inflation data is coming out through the CPI, the Consumer Price Index, and other data reports that came out this morning.
Which come out what? Once a month, once a quarter?
Once a month for the
Okay.
prior month.
Okay.
So the report that came out today was for October.
Gotcha.
Now, this time right now is so important because it is widely expected from analysts that there's going to be a shift for a few months where last October to this October, the rate of inflation would be lower.
So
that-
year over year, it's lower today than
On
it
the
was
same month,
than it
yes.
was last October.
Exactly.
Oh, wow.
And
Okay.
that's exactly what happened this morning. And the immediate result was that mortgage-backed securities went up dramatically, which actually brings mortgage rates down. And the 10-year Treasury dropped 0.25%.
Wow.
0.25%
Like-
in like an hour.
Oh yeah.
Wow. So
Unbelievable
that's
move.
huge news in the lending market because that's something you've been preaching now. Like, hey, keep an eye out for it. You're going to see this. You're going to see it. And it sounds like we're starting to see it.
And this is the first of potentially 5 months of, year over year in the same month where we see the inflation go down, which means that the Fed, what they have been doing is starting to work. So if it works for, these next couple of months where we see November to November a reduction in inflation from year over year, and
Yeah.
December to December, and then
Yeah.
January to January, February to February, then we can really see a nice improvement with interest rates and this skyrocketing rate, literally where rates have doubled in the last 9 months. We could see that draw to a close,
Wow.
That's awesome.
to where they at least settle down.
Yeah. Well, they're not doing this ebb and flow thing.
Yeah.
All over the place.
And-
They haven't been ebbing and flowing.
It's going up. Yeah, true.
They've been ebbing and ebbing.
Evan. We're
So-
waiting on the flow.
But what you're saying is from a practical perspective, you could be calling people later today after this podcast and saying, hey, it's time to lock your rate. Or, hey, we're going to be locking your rate as we see this shift continue to happen.
Exactly.
Okay. Which is great news because right now people are, they're locking. No, don't lock my rate. Please don't lock my rate at these rates. So,
Well, let's touch on that. So let's say, just give an example here. So what is the rate yesterday? What's the rate today? And I know you don't like that question because you hate answering that question, but just so we got an example here, hey, rate was this yesterday. Today, because this shift has happened, we've seen it change by.
So it's hard to answer what's the rate.
Yeah.
It's kind of like saying what color is the house.
That's right.
Because there are so many factors that
Variables.
determine the customer's interest rate. But it's also important to explain that a customer doesn't have just one rate option. If they're quoted one rate option, it's simply because the loan officer only took the time to give them one option.
That's true.
okay.
What I like to explain to my customers is when I price their loan, I don't see one rate. I see what I call a rate stack. So it's maybe 6 or 7 or 10 interest rates that the customer qualifies for, and then provide that customer with the option to choose which rate they want at the corresponding cost or credit.
That's right.
And then let them choose the rate.
Gotcha.
So what has happened today in the market is since this morning, if it sustains itself throughout the day, we could see a 0.25 to 0.375% drop in mortgage rate from yesterday.
Today. Okay.
Really
that kinda gives us
across the board.
perspective.
Yeah.
Exactly. Well,
Yeah,
And that was kind of what I was aiming for is what is this change meaning?
Yeah. Yeah.
So if somebody's coming in, let's say that they've been quoted their rate at 6.25, which probably isn't right. It's probably more like
Right.
7.50 or something like that. But let's say that that's the case, and now they're going, oh man, I can do this rate drop. Now you had said something earlier to us before we started that some lenders, and you guys are one of those, that you can potentially do kind of a drop down if they had already locked. Is that right?
Sure. Most lenders offer something like this if you ask for it. I like to tell my customers that it's typically available if you have a day like this, where the market moves so the market move is so
Dramatic.
large. Yeah. And so, for example, October 20th, we know that was one of the days where the mortgage-backed securities were at the lowest point, which means the interest rates were at the highest point.
Okay.
Yeah, there you go.
Now today, if somebody locked on the 20th of October, the change between that day and today is so dramatic that most lenders would float that customer down to a lower
rate.
rate. As long as the rate can drop at least 0.25% and the mortgage-backed security has moved at least 100 basis points during that time, then they would be able to float down. Well, with the moves today, you're talking about over a 200 basis point
Wow.
move
That's a huge drop.
since October the 20th.
Wow.
Yep.
That's awesome. And that's at no additional cost typically for lenders
Some
to
lenders
do that float
charge
down?
for it. Some
Okay.
lenders absorb it.
Gotcha.
Given the
Okay.
scenario.
Yeah. Okay. Yeah. So we had a scenario where you were talking about putting a little bit less money down and actually being able to take that and use it a different way that would affect your payment more dramatically. So talk about that a little bit more.
Sure. So it's common. I'll have somebody have a payment target in mind that they really can't achieve with what they want to do. So, for example, they want to put 20% down on a $400,000 house. Well, that's $80,000. But it's still not going to get their payment where they want to be. So what if we do something different, and let's say we put down $60,000 instead of $80,000, but then we take that other $20,000 and we put it in a money market account. Okay. So you can literally withdraw $500 a month for 3 years from that money market account to pay the difference of the comfort zone of the payment and what the payment actually is by just having the money that you already have. Keep some of it for yourself and use it to help you pay your payment.
Gotcha.
For 3 years.
Yeah, which actually it kind of accents what we're talking about. Sometimes you have somebody and they say, hey, I want this solution. They don't need the solution for 30 years.
Right.
They need the solution for 2 years, 3 years, 4 years because they're finishing up school
or
because
paying off a car.
Maybe their spouse is in school and they're going to be finishing up and going into a full-time career. And so they're saying to themselves, wow, I can't make the payment in my current budget. I need it to be, in your example, $500 lower a month. You don't need it $500 lower a month 23 years from now, but you're really trying to solve more of a short-term cash flow problem.
That's right.
And it sounds like that you're helping folks think outside the box a little bit more so that they understand, hey, this is probably only a problem for the next 4 or 5 years till you get that car paid off. Let's do it this way so that you can put yourself in that position.
Well, and that's another thing that I really liked about Don was, we had talked about this before. Somebody comes in, they got $100,000, and it's like, hey, I want to put $100,000 down. And you're like, well, why don't you pay off your car and your credit cards and all that? And we just saved you, I don't know, $8,000 on your, whatever it is, $800 a month or whatever.
Right.
This dramatic amount of money. And you're like, well, if I put $100,000 down, it's going to shorten my payment. It's like, well, if your car is $600 a month, you can save that instantaneous, and you still have $50,000 left over, right?
Absolutely.
So I mean, those are some of the beautiful things that I've liked about you've brought to the table. And like, hey, well, let's do this differently.
Yeah.
Well, here's another strategy I use all the time. Literally every single loan. I talk to customers about this. So when a customer goes to get a quote on homeowners insurance, they typically do it with a very low deductible, so $500 or $700. Okay. I recently had a customer who was quoted $2,600 on their homeowners insurance.
Wow.
That's more than $200 a month, right?
That's a lot.
Yeah, it is.
So what I suggested is she look at a higher deductible. So instead of the very low deductible, the customer took my advice, went to $2,500 deductible. She had the room on her credit card, so if there was ever a problem, she could just put it on there.
Yep.
So $2,500 deductible, and it dropped that homeowner's insurance down below $1,000.
Wow.
I think she was like in the $600 range, $650. That dramatically changes her payment.
Yeah.
More so than dropping the mortgage rate 0.25%.
Right.
Well, let me ask you a question. So is there a certain amount of deductible that's required on a loan? Because I know there are for cars and different things like that, but I wasn't sure on the mortgage angle.
It depends. I mean, we close loans with as much as $5,000 in deductible.
Okay. So 5 is probably the cap in most cases.
I've never suggested more than that.
Yeah. Okay.
But if a customer has good income and they're payment conscious on the mortgage loan, but they also have tons of open credit cards and available trade lines, credit line, I'm like, absolutely, pay a higher deductible because you're only going to pay it when you need it.
That's right.
But your premium, you're
paying every month.
You're paying every month in your mortgage payment.
Yeah.
How do we lower your mortgage payment? We do that.
Well, it's like you said. I mean, let's just talk about that lady you said. She was at $2,600 a month, right?
No, $2,600 for the year, which
is
over $200 a month in her mortgage payment.
So she's $2,600. She goes down to, let's say, $900. She saves herself how much? What's this, $1,800?
$125 right there.
Yeah. So, but overall, the year, you're talking about that year after year. Let's say that's just 3 years. Your $5,000 deductible, which, I mean, let's be honest, most of us haven't probably used our insurance on our home often, if at all.
Yeah.
So, I mean, it's a huge way of looking at it. It's like, hey, if I save this amount of this $1,600, $1,800, whatever it is that she saved, I put that in a savings account. Now, in 3 years, anything that comes through, I've got $5,000 there for my deductible.
Sure.
And now I've made a wiser decision anyway. I don't even have to go into debt on it, which if you have that, issue, then that's fine. But you could actually save yourself that money versus going the other range.
Right.
Well, and it also saves you money at closing.
That's right.
If you cut the,
you don't have to put it out.
If you if you drop from $2,500 to $500 or whatever, $700, well that reduces the amount of money you got to bring to closing, and then it also reduces your mortgage payment, so you get the double whammy there.
Yeah.
No, that's a genius idea.
I mean, just to kind of begin to wrap this up, I mean,
Sure.
I think we're going to do more of these episodes.
Oh,
It's going to be
definitely.
awesome because we're going to have to dive into a bunch of stuff, and I want you to keep us updated as we go on the shift and how we're moving. But as we sort of wrap it up here, I think the big thing is just you thinking outside the box and you being able to teach a buyer how to think outside the box. It's not just about this loan program, this loan type, this payment range. It's no, let's look at the financial picture as a whole, the goal for your home as a whole, how long do you feel like you're going to be in it, et cetera. And let's design and structure a program that fits your unique needs instead of, like you said, an order taker.
That's right.
Yeah.
Yeah, that's good. Well, guys, we thank you for joining us on this podcast. We're going to probably have a few more of these that'll be coming out. These will be kind of like special editions, if you will. So they'll be outside of our normal Thursday drops.
Yep.
But if you can, subscribe to our channel. Also, share this with some friends, people that are looking at buying a home. And if you need anything, feel free to give us a call. We'd love to help you.
Yep. We'd love to connect you with Don. So reach out to us. We can certainly have his team working on whatever you need. And Don, thanks so much for your time and being on the show.
Absolutely. Happy to be here.
All right.
All right, guys.
See ya.
See ya.